Today on Your Money, it's Investing 101. Class is in session. We're going over the basics on how to get started, the best destinations for your dollars, plus artificial intelligence, why it's having such a big effect on the market. It's all coming up next. Welcome to Your Money. I'm your host, Gordon Severson. Today I'm going to be talking about investing. It's complicated. 401ks, Roth IRAs, all the numbers and information can be very confusing. But I'm breaking it down to help you make your money work for you. And the harder your money works, the faster you can achieve your financial goals, whether it's saving for a vacation, a new car, or an early retirement. And this story out of Alabama has some great advice for getting started. Check it out.
You have to have a little bit of courage and you have to have a little bit of patience.
There's no quick route with investing.
It's taking blocks like Legos or Lincoln Logs or whatever. I'm dating myself talking about Lincoln Logs and trying to build something for the future. And that's the entire idea. What we try to teach our clients when it comes to investing is as you're preparing, you're putting money away on a regular basis.
And the end result is simple.
What it does is you build up wealth. And then when you have wealth, that opens up more doors, opportunities throughout life.
Getting started doesn't cost a lot.
If you pay yourself every single month, I don't care if it's 5, I don't care if it's 10, 15, it doesn't make any difference. That's where you start. Time is the most important thing when it comes to investing. It's not the amount that you're putting in, it's the time that you put in.
And your job could be the best place to start.
Let's say if your job offers you a 401k or some sort of retirement vehicle like that. Take advantage of that, because what that also is going to do is it's going to lower your tax basis as well. Not to mention, many employers will also match to some degree with what you're putting in. But you want to go with something that's stable and conservative, not ultra conservative and not ultra risky.
But also remember to breathe.
You might be watching a business program and they're talking about this hot stock. I got to get in it now. No, take a deep breath. Take a deep breath, take a couple steps back, okay? Don't go diving into things, don't making all sorts of crazy changes. Remember, okay, that there's no shortcuts out there.
While you're trying to grow your net worth, it can be tempting to chase after the high-risk, high-reward investments. Things like Bitcoin and growth stocks are flashy, but can also clean out your bank accounts in no time flat. But what about Treasury bills and bonds? They've been having a moment lately, and here's why you should consider this low-risk investment.
There's a better alternative than keeping your money in the bank or under the mattress.
And that alternative is called Treasury bills, or T-bills.
It is the single safest investment on the face of the earth. They're guaranteed by the full faith and credit of the U.S. government.
And you don't need a financial advisor like Paul Schatz to buy them, just a website. In fact, you can only buy them digitally and only on one website.
TreasuryDirect.gov. It ties in right with your bank account.
If you're not familiar, T-bills are a lot like savings bonds and certificates of deposit, or CDs, that you'd buy at a bank, just without the bank as a middleman.
You're loaning your money to the government so they can fund the debt. And in return, they're paying you an interest rate.
They differ from stocks in a number of ways, both good and bad. The first of which is the rate of return. To be clear, if you can afford to do long-term investing, Schatz said the stock market is still the gold standard.
The stock market has been the single best performing asset over the long term. Depending upon which index you choose, the Dow or the S&P 500, you're going to get between 8 and 9%, including dividends.
Now, Treasury bills can't guarantee you 8 to 9% profit a year, but counterintuitively, the stock market can't either. That's because it averages 8 to 9% a year. And when you look at what the Dow Jones has done in 1 year chunks, you'll see why. Look, in the late 90s, you were getting 20 to 30% profit repeatedly. On the flip side, in 2008, it lost 30% in 1 year. That's why it's crucial to make sure you have your money in the stock market for a long time to even out these wild swings. Otherwise,
you don't get that really smooth, really easy to accept, non-panicky path.
Now, the allure of T-bills is that their rate of return is guaranteed because you're loaning the government your money at a set interest rate. Granted, 2 years ago, that interest rate was effectively zero. It was so low that a $10,000 investment was only making you $1 in profit profit a year. But then when the federal government started raising interest rates to combat inflation, look at this, boy, did things change. Now that $1 a year is closer to $500.
It is the most meteoric, epic, historic, parabolic rise on a percentage basis in history. Yeah. We've never had rates go up on this trajectory in history.
So now you have two good choices. 8 to 9% a year in stocks, but that's not guaranteed, or over 5% a year in T-bills that is guaranteed. And what also sets T-bills apart is how short-term they are. You can set them to mature in as long as a year or as little as 4 weeks, so you're not tying up your money for too long.
It's free. No fees, no cost, no expenses. They take money out of your account and they put it back in.
These rates won't last forever, so if you think Treasury bonds or bills would be a good addition to your portfolio, act fast. You can also buy corporate bonds with companies, so there are a lot of great safer investment options out there if you want to stay out of the stock market. Inflation, it's a bit of a dirty word in the financial world, except when it comes to your savings account. I've talked about high-yield savings account on this show before. In a normal savings account, you can see your money grow by pennies every month, but these accounts can deliver returns at a much higher rate. This story out of Denver has the details.
Savings account.
If you spent any time online,
build your wealth.
You've heard the buzz about high-yield savings account.
Best believe my money's gonna work for me.
For those of us of a certain age, it sounds tempting. We're used to savings accounts that pay pennies, not dollars in interest.
Frankly, money in a savings account wasn't doing a whole lot more than money sitting in a jar, right?
Eric Crom is the president of Clear Creek Advisors and a certified financial planner. We asked him the first question, what is a high-yield savings account?
It's really no different than your general savings account.
It's just as liquid as a traditional savings account, meaning you have access to your money just like you would there. And instead of the traditional savings account that offers an interest rate on average of about 0.4%, these accounts offer anywhere from 4 to 6% APY.
And as we felt inflation come hard, and we were dealing with the negative impacts of that from an expense standpoint, one of the silver linings is that we can now make some money on our safe investments.
Crom says these accounts are protected just as much as your traditional savings accounts. The FDIC covers up to $250,000.
Every dollar you have, you might as well get as much as you can.
The cons, you're usually only going to find rates like this at an online bank, which can make some people uncomfortable.
The reality is online institutions probably have less overhead than brick and mortar, so they're paying more.
And that 4 to 6% return rate may not last forever if the feds lower interest rates this year.
So a high-yield savings account won't offer the same returns as other investments. Don't plan on parking all of your life savings in this account for the long term. But for short-term savings like a new car, a vacation, or something like that, it's a great place to put your money. Tech stocks are hot right now, especially Nvidia. Since January 1st, the S&P rose 36%, the Nasdaq 57%, and the Dow Jones is up 19%. And this tech stock, powered by the company's work in artificial intelligence, has risen over 579%. So why is Wall Street so fascinated? A lot of the excitement has to do with the potential of this technology. AI can lead to advancements in healthcare, science, business, and so much more. Plus, using AI can save companies money and drive higher revenue and profits. But it's not just about what companies are doing right now. The stock market is banking on how AI can change our lives years down the road.
And the stock market is simply reflecting that impact that artificial intelligence will have, not just next year, but 3, 5, 10 years down the road. And then you expand that potential impact on a global basis.
NVIDIA has become the primary maker of the complex computer chips needed to power AI processors. And as global demand increases, the company is ramping up production, causing revenues, profits, and by association, stock prices to soar. 10 years ago, if you bought $1,000 worth of NVIDIA stock, that $1,000 investment would now be worth over $210,000. When it comes to investing, there's a lot out there. There's so many things to get you feeling like you're overwhelmed and you don't even know where to start. So we're going to take it back to basics. And to help us do that, I've got Grant Meyer from GTS Financial. Thank you for coming on the show with us.
My pleasure. Happy to be here.
So let's take it back to the very basic. The word investing. What exactly does investing mean and all entail?
Well, essentially, at the most basic level, it is taking money and applying that towards our future goals. Really, that's it. Now, to get a little bit more specific than that big, broad picture, there can be short-term goals we have where we can utilize certain types of investments, and then there are those long-term goals. Think retirement or big purchases that we have in the future, like a home or a car, and figuring out what kind of investments fit those goals. That's part of the problem.
And I think with a lot of people, when they hear the word investing, their mind immediately goes to stocks and the stock market. But that's actually, a rather, I wouldn't say a small part, but it's just one part of what investing overall is.
So there's kind of a broad spectrum, like you alluded to. Generally, starting off in the investment world, we have very safe, short-term things like savings accounts, CDs. Those can be investments for short-term savings goals, building up an emergency fund, for example. Other types of investments we have, say, medium risk investments, these things called bonds, which is just a fancy way of saying an IOU from someone where you can earn interest and they're a little less volatile, meaning they move up and down a little bit less. And then we have investments perhaps in real estate, for instance, buying investment properties, renting those out. Those are a little bit more longer term investments, less liquid, a little bit more risk. And then of course you have stocks in the stock market, and you can combine all of those into other investments called mutual funds and ETFs. So there's certainly a broad spectrum, and trying to determine which type of investment you use really depends upon the goal and the time horizon of the person.
And when I talk to a lot of people and they hear the word investing, a lot of people get kind of scared by it because they assume it's going to be risking. They think of gambling, like they say,
sure.
like it's the stock market. But there's a lot of different types of investing, and if you have a lower risk tolerance, you can still get involved. If stocks are something that's just way too scary or overwhelming for you, there's so many other ways that you can invest your money for your goals, right?
Absolutely. I'll give you an example. Driving a car. We can drive a car under the speed limit, wear our seat belt, obey all traffic laws, be a defensive driver, but we can also drive a car very aggressively, go over the speed limit, ignore stop signs, things like that. So just because we're driving a car, we can do it in different manners. So likewise with investing, we'll pick on the stock market. There are ways to invest that are highly speculative, which is just a fancy word for saying very risky. You could put your money in there and never see it again. But then there are time-tested, long-standing investment principles where we can say we can utilize these things called mutual funds in an index that keeps our costs low. And multiple studies show, at least historically speaking, that if you put your money in those, leave it alone, come back a long time from now, you'll be in a better spot, and there's a little less risk with that longer term approach.
And at least bonds, like you said, and CDs, another way to invest if people have a very low risk tolerance.
So if you have a shorter time horizon, meaning we're going to need the money in, say, 3 to 5 years, or if we don't want to take as much risk for whatever reason, there are bonds, which we can get into some specifics around. There are aggressive bonds and conservative bonds, but generally bonds compared to stocks are a little less risky, but they give you a better return than sitting in, say, just cash in a money market or a savings account. So bonds are a nice step into the investing world. And generally, most people have some bonds in some way, shape, or form. When we get towards retirement, we start to utilize them a little bit more. Or if you're starting off, maybe there's some more aggressive bonds that you want to put your money into, which may provide a little bit more growth. So there's a spectrum of bonds out there. And one surprising fact a lot of people don't know, actually, is when people think about investing, they think about the stock market. But the bond market is actually exponentially bigger. There's more money flowing through the bond market than the stock market, actually, in any given period of time.
Yeah, and that's a good way to kind of preserve your wealth, preserve your money. If you're not spending it, if you're saving it for retirement or a goal, a bond, you're going to get a certain amount of money back each year, whenever it pays. And it's just a good way to kind of have it out of sight, out of mind. And oftentimes, if you're investing in certain types of bonds, something pretty drastic would have to happen for you to lose that money. Like a government would have to go under, or as long as you hold it through maturity, depending on what kind of bond you're getting.
Yeah, so there are some specifics to be aware of. As I mentioned at the top of the segment, a bond is just an IOU. And how risky that IOU is, how risky that bond is, depends on who you lend the money to. Mm-hmm. So we could lend our money to the US government, and generally that's considered one of the safest investments in the entire world. We can also lend our money to small companies that don't have a long track record, that have maybe sketchy financials. And these are called high yield bonds or junk bonds. And those are more risky in that if the company goes under, we may not get our money back. So there's a spectrum out there. Or we could get a bond from a big company, say Coca-Cola or Procter & Gamble or Microsoft. Facebook just announced that they're potentially doing some like dividends and ways to collect income. So there's a spectrum in the bond world, but you're absolutely right. If we have a mutual fund, which maybe blends these types of investments together, generally something, earth-ending would have to happen to lose a lot of money in the bond funds over a long period of time.
And with bonds, the biggest thing, like you're alluding to, is the more risky it is, the higher the reward. Mm-hmm. But the higher, the more risk you take on, the more likely you might lose your money altogether. And that, that has happened, where people get bonds from companies and the companies go under, and you don't get it, but they're paying you a higher rate for that risk.
Exactly. If you just focus on that interest rate that you're getting, that may be a little short-sighted, because the higher interest rate bonds are going to be from riskier companies. So if we want a little bit more return, potentially stocks might be a portion of that rather than just all into these risky junk bonds, because if they go bankrupt, you probably won't get all of your money back, and that has happened in history for sure.
And with investing, a lot of it is having a longer term mindset where you're thinking about after tomorrow, what's going to happen next. And you can really put your money to work if you have that longer thought process.
And with investments specifically, you mentioned a fantastic point that I think is deserving of emphasis, which is many people tend to focus on the short term. What has done good recently? This particular stock, I like it because it's done well right now, or this thing did poorly, I lost money, I'm going to get out of it. Most studies show that people, when we follow our gut emotions, are terrible short-term investors. Most studies say the best thing to do is, it's fine to check up on your investments maybe once or twice a year, but you'll have a lot less heartburn, a lot less anxiety if we put our money to work in some well-established investment instruments. Leave it alone, check on it periodically, let it do its thing. Selling when you want to get out, generally a bad idea. Buying more when things have gone up, generally a bad idea. People can be their own worst enemies psychologically, which is an interesting factor in that too.
That's a great point. Whenever I often have people in my life will ask me, hey, where should I put some of this money, or where should I invest? And my question that I ask them is always, when do you need the money? Mm-hmm. What is it for? And you alluded to this earlier, is that there's short term and there's long term. And that's a good first question, because what you need the money for greatly affects where you're going to put that money. If you're going to be putting it in a house fund and you're going to buy a house in a year or two, you might not want to put it in the stock market, because a lot can change, and that could be cut in half or could double. Yep. That's a big question we should all be thinking about, is what's this for and how long until I need it?
Absolutely. A good general rule of thumb that I always tell my clients is, if you need it for sure within the next 12 months, the next year, absolutely do not put it in the stock market, period. You want to look at CDs, potentially savings bonds, potentially money market funds, because if you know you're going to need the money, we could come back and we could have less money for that purchase, which never feels good. Once we start to get past, say, 12 months, 18 months, year and a half, then we can start to think about potentially using stocks for maybe a portion of that. The real long-term money, retirement, like in our work 401k plans, that you can lean a little bit more heavily into stocks, generally speaking, because we're not going to need the money. They will move up and down, but the long-term trend historically has always been pretty positive.
And my last question is probably something we should have asked earlier, is if someone wants to get into some of these more classic style ways of investing with stocks, bonds, how can they invest? I actually remember just recently watching a rerun of Friends, and one of the characters wanted to invest in stock, and she calls the operator and she's like, get me the number for the stock store. Like, she didn't know where to start.
Yeah.
And I think a lot of people are like that, where they're like, who do I call? What kind of an account? What's a good place to start for people?
So the best place to start is a work retirement plan. Generally, most employers have some sort of match. So anytime we talk about investing, that's the first step we go to, contributing enough into your plan to get the company match. And the interesting thing with 401ks, some pros and cons with them, but the investment options are pretty limited, but that means you don't get into this overwhelm of which investment to pick. You have your investment options, generally some stock and bond funds, start there. That's a great place. From there, we want to look at places that have low costs, that don't charge us a lot to trade. There are some bigger firms out there, potentially a classic one is Vanguard, is a great low cost, easy place to get into. Apps are very popular right now, right? Some of the more bigger names, one might be Robinhood, for instance. I like that the apps encourage people to invest and understand the markets. Potentially there's a little bit of a negative connotation with them, and that they're maybe more apt to be, I guess I would say, abused as, say, gambling rather than investing. So many apps, though, their general purpose is keeping costs low, making easily accessible right at your fingertips to invest. And if you're picking investments that are big mutual funds, ETFs, indices, where that's a bunch of investments together, rather than trying to guess and pick one stock that might, make you rich in the short term, that's generally a good strategy and a good way to tiptoe into investing.
Some great advice. Well, thanks so much for coming on the show and giving us a quick introduction into investing.
My pleasure.
Welcome back. I've been talking a lot about what you should do as you start to invest. Here's the flip side, a story out of California about the common pitfalls to avoid with your investments.
But when it comes to investing and having success in investing, the less emotion you can have, the more objectivity you can have, I think overall long term you'll have a higher probability of success.
Number 1, emotional investing. Fear and greed are powerful emotions. When it comes to money, don't let them steer you off track. Sacramento-based financial planner Joseph Eshelman says you could be tempted to make bad decisions, even if the economy is doing well or doing poorly. So stay rational and objective and stick with your plan. Number 2, information overload. We can't get enough of our phones these days. But with advertisements on social media, emails, and even texts from our friends, information spreads fast. And not all of it is, shall we say, helpful, especially when it comes to investment advice.
Inherently, there's some sizzle and some sexiness to those type of ideas. It does kind of fly in the face of having a cohesive overall objective plan in place, and to not just be grabbing at all these different shiny ideas.
Joseph warns you not to fall for hype, trends, or alluring headlines. He suggests you be steadfast in your strategy and don't be distracted or gamble for short-term gains. Number 3, Uncle Sam. There's no avoiding taxes, so don't let your dislike for taxes keep you from helping your money grow. For example, one investment you can make is owning bonds. The interest you earn on California municipal bonds are tax-free, and that's good news. But the interest rate is lower on California municipal bonds than some other bonds that are taxed.
If you have a California municipal bond at 2%, you're not paying any tax, so you net 2%. If you have a regular bond that's paying 4%, maybe you pay 1% in taxes, but you're still netting 3 overall.
Bottom line, crunch the numbers on your investments. You could still end up earning more money even if you had to pay taxes on it.
So the bottom line with these investments is really patience, patience, patience. If someone is trying to sell you a get-rich-quick scheme when it comes to investments, you know they're trying to sell you a scam. I want to leave you with one last piece of advice when it comes to investing. It doesn't have to be complicated, and it doesn't have to be risky. If you're not comfortable with the ups and downs of the stock market, maybe CDs and bonds are the way to go. You won't get the same returns as the market, but you will have the peace of mind knowing that your money is in a safer place. There's no wrong way to invest as long as you have a plan and you're comfortable with that plan. Well, that's all for today on Your Money. I'm Gordon Severson, helping you save, spend, and invest your money wisely. I'll see you next time.